every day, businesses and households are making decisions around whether to spend today or wait. And that in and of itself is going to create an impact or transmit to how inflation plays out.
We're leading into today's podcast with a good little giggle here. We know that bonds, fixed income might not always be the life of the investment party, but certainly it's a steady hand that stabilizes portfolios through market turbulence. Now, with inflation proving to be a little bit more stubborn than expected and interest rates keeping investors on edge, fixed income is back in the spotlight, and that's what we're going to be talking about today. What does it mean for returns? What does it mean for credit markets? What does it mean for all that cash that's still sitting on the sidelines? Today, I'm joined by Michael Augustine and Alex Gorewicz to break it all down and help you navigate the evolving bond and rate landscape. Welcome.
Thanks, Ingrid.
As we're recording this, we've just seen January inflation data. U.S. inflation data has come in higher than expected, around 3%. Maybe, Alex, I'll start with you. What does this mean? How do we think about this inflation that's proving to be a little bit stickier?
I think the cleanest way of assessing, the macroeconomic backdrop is that the U.S. economy is resilient. And more recently, yesterday, in fact, we got Canadian CPI data that, despite the headline being around 2% or just shy of it, showed some underlying strength when looking at the details, not too dissimilar from what we've seen in the U.S. And in particular, it's sort of the stickiness in services inflation that has policymakers worried that disinflation has stalled, right? The path to their 2% sustainable inflation target has stalled. And as a result, when we think about all of the policy rate cuts that we've seen, right? 200 basis points or 2% rate cuts from Bank of Canada since last June, 100 basis points or 1% from the Fed since September. We now think that, they have cover to pause, wait and see what their rate cuts mean for the economy from here on out.
We've talked about, the rate environment in the context of inflation, but we now have this new wild card around tariffs, playing on both, north and south of the border. How do we think about that? If you had a risk reward path 6 months ago or 3 months or a month ago,
Right.
How has that changed?
That's where there are differences between U.S. and Canada. Our economy is, although it's showing some green shoots, we've had a couple of strong, labor prints for the last 2 months. Again, some of the stickiness or resilience in inflation. All of that is in large part because, consumption is holding up decently. The economy is not great, but it's not horrible either. Unfortunately, because of that, walking the tightrope between, we'll call it great economy versus not so great economy, the threat of tariffs for Canada is going to be highly negative. Even just the general, looming, tariff threat is going to be highly negative for our economy because it changes consumption patterns and it changes business investment, intentions or plans. Even with all the rate cuts that I mentioned, Bank of Canada has delivered. But the good news is that Bank of Canada is still where it would call itself in the neutral range. In other words, its policy stance right now is neither accommodative nor restrictive. And that means that it has a lot of room to lower the policy rate to address any kind of negative economic impact from tariffs if they do materialize.
Yeah, so looking forward from here, the status quo to another 100 lower is all on the table, let's say, for the next 12 months.
Absolutely. But even without tariffs, Bank of Canada still has room, we believe, to continue to lower the policy rate. It just won't be at every meeting the way that they have until now. But absolutely with tariffs, they've shown that they think the GDP impact, negative GDP impact, will be much more material this year if tariffs materialize, and we therefore expect them to react by cutting interest rates, not even 100 basis points, possibly more than that.
We're focused today on fixed income markets returns, but investors' portfolios are typically much broader in terms of equity, fixed income, and equities in different jurisdictions. Can you just take a moment and talk a little bit about what that means from a currency perspective and how we think about that?
What we've noticed, you've talked about the different timeframes, right? Like it lasts 1 month, last 3 months, right? So as the last 1 month has brought about a lot of volatility around tariffs, what we've noticed is that currencies are most reactive to those tariff developments. That's not to say that bonds or equities are not reacting. It's just currencies are reacting the most. And this is where it's really hard to say or to have strong conviction that, the US dollar is very overvalued against all of its, developed market peers. So it's time to fade the US dollar, or, the Canadian dollar is very weak. It's time to go long the Canadian dollar. Now, unfortunately, the tariff developments are still what I'd call binary, right? They either will happen or they don't. And it's hard to have strong conviction on how to, balance those probabilities. So as a result, when we think about currencies, and again, just this sort of looming threat of tariffs, even if they don't materialize, I think it's going to result in a lot of the status quo that we've seen so far, which is, a relatively weak Canadian dollar and a relatively strong US dollar.
So, Mike, you lead the fixed income teams here at TD Asset Management, overseeing hundreds of billions of dollars of our clients' assets. How does the rate narrative play into some of the ways you're thinking about portfolio construction potentially?
Yeah, so maybe start by looking at rates. So last year we saw the FTSE in Canada return about 4.25, right? So mid-single digits. Vast majority of that was income, a little bit of capital appreciation. And I think Alex and I might have been here this time last year, and we were talking about income, and that would be the primary driver going forward of returns. So I think it's important to sort of step back and sort of see where we are in terms of rates. We're at a high watermark of the last 15 years, right? Rates, there's a lot that's been said about credit spreads being tight, but underlying rates are quite high. I know one of the things that we always look at is what's the starting position for investing and how much of a buffer do you have, right? So Alex talked about some of the scenarios with which the Bank of Canada could lower rates. What if rates went against us and they went a little bit higher? Well, one of the things that provides comfort right now is that there's a certain amount of buffer, and it's higher than it's been in many, many, many years. That's protecting portfolios. So you may take a little bit of capital depreciation if the case of rates going up happens, but you're protected with the income that's coming in throughout the year. So we're going to have this constant focus around income. And then when we think about the sources of income, credit is going to continue to play a meaningful part of how we put portfolios together and think about portfolio construction.
We think ever since the financial crisis, like we had, a decade and a half almost of investors being penalized, right? Savers were penalized with these historically really, really low rates. Then we had the rate shock as the rate environment normalized and people took that capital hit to their bond portfolios, both of which could really rattle investors. But as you say, we're in such a better place now because barring any move in interest rates, your day in, day out coupon return is quite attractive now, more attractive than the alternative GICs. And then you have the benefit of, potential lower rates, all things equal, which is going to give you some of that capital appreciation potentially, right? So you're right, it's really a tremendous environment. I want to talk a little bit about, I'm going to come back to the tariff piece because we've opened the door on the credit conversation, and credit, for our listeners, it's that part of the portfolio might be either provincial credit or corporate credit. So let's talk a little bit about the provincial sector first, because certainly some of the tariff threat can be quite damaging to the provincial landscape. How are we thinking about spreads in that space?
Well, spreads in provincials are not too dissimilar from corporate bonds in that, they're very tight. And there are good reasons for that. Again, the economies have been generally resilient. Provinces in particular have done a really good job in getting ahead of their funding needs. So taking advantage of investor demand when it was, red hot. And I think that has served them well. Part of the problem, though, when we look forward is, and this is true for all levels of government, is that the private sector will look to government to really create a bit of a buffer against tariffs if they do materialize. This puts some of the larger provinces that have very diversified economies and diversified manufacturing bases in particular, like Ontario and Quebec, puts them in more vulnerable positions. And so while we're not overly worried about meaningful credit spread widening in a tariff, scenario. We do see some of the provincial names to be more exposed than others.
Yeah, but still fairly stable. Like we're talking some basis points, not wholesale move. And I think that's one of the important things we were talking about is the role that fixed income plays in an overall portfolio to dampen volatility. The expected outcome is income return plus a little. The worst case scenario, as you say, is if we do have a backup in rates, you're still well protected from that through that day in, day out income that you're earning in the portfolio. For the fixed income funds type landscape, the types of strategies out there. I want to go a little bit deeper, when investors are looking at their options. And I think there is some, concern about fixed income performance. Interest rate sensitivity or duration in this environment is a key driver of fixed income returns I think many worry about. Maybe let's start by grounding our listeners on the concept of duration. We throw it around as bondies, but what does that really mean?
So you've mentioned interest rate sensitivity. So let's take a typical corporate bond portfolio in Canada as we'll say plus or minus 5 years. So what does that 5 years mean from a return potential point of view? If interest rates rise 100 basis points or 1%, which is a huge move, you take that duration at 5 years and the price impact to your portfolio, right, the capital gains impact would be negative 5%. Now, we've talked a lot and you've heard my talk about income, right? And that being an important driver of decision-making and portfolio construction for bonds. If you look at the portfolio yield, so let's say it's around 4.5%, that is income return that you're going to accrue throughout the year. We usually look at yields on an annualized basis. So if it's 4.5%, that's about what you're getting as income return throughout the year. What that means from a total return perspective is that you have that negative price impact of minus 5% plus the 4 to 4.5% offsets, right? So then the total return impact, even if interest rates rise, which is a concern, as you mentioned, that some investors have about bonds right now, you would end up in a scenario with almost flat, slightly negative fixed income returns.
And I think that's really important is for our listeners to understand that component of income in a fixed income portfolio is that buffer to rising rates, because you have the two components of return, and even in the 100 basis point rate environment rise, which we don't anticipate.
No.
Income is always that buffer. And cornerstone to how we invest in fixed income here at TD Asset Management is typically more yield, more income, more exposure to credit than typical. That is our belief that it is one of the most consistent ways to add value to our portfolios. Like, what other tools are you using or adding to the portfolios to support that generation of income?
Yeah, no, it's a great point, Ingrid. If we start from what we do at TDAM, we do, extensive independent credit research. And the confidence in that research allows us to overweight this in portfolio construction. When we think about that, there's many different ways to express that credit confidence. First is in the public markets, and we've been doing this for a very long time. But one of the nice things that we introduced almost a decade ago now was an extension of that, sort of a tangential capability, which was extending the same methodology to private markets. So I know David Sykes always says the only free lunch in investing is diversification. And that's one of the nice things about moving into sort of private fixed income, for example, is that you're getting diversification. In the Canadian marketplace, you're not getting exposure to hospitals. You're not getting exposure to solar panel companies. You're not getting exposure to real estate directly. So when you go into the private markets, it gives you that diversification, right, which is welcomed. The other thing that we like is yield enhancement. So again, you can get the diversification, but get paid for it. A lot of private fixed income deals don't fit into traditional bank lending. People want customized schedules. They want to draw down when they're building something. They want to pay off once something's built. They want that uniqueness, and we refer to that as a uniqueness premium or an illiquidity premium in some respects, in that you're getting paid for some liquidity. And then lastly, you'd think if you're getting more yield, how can it also be safer? But it is. When you think about public securities, they're often unsecured. When you go into private markets, there's something standing behind that loan that you've made. There's something you have a claim to if there's ever a problem. So you get that safety. So putting these all together, it's a great complement to the public fixed income allocation. So we like private fixed income. You can kind of think about commercial mortgages in the same vein. You can think about leveraged loans, and you think about high yield. So the opportunity set in credit at TDAM for fixed income is quite large. And then if I just think, just to put some numbers to that, if I think about the returns of a core plus strategy last year being sort of 5.5% roughly, you could think of a commercial mortgage allocation of being 7.75% return last year, private debt 7.25% return. So you start to get meaningful enhancements to your corporate allocation when you start to go into the private markets as well.
Yeah, and they can't be accessed by just anybody. We have teams that do that for us, that get us the access to those markets, which we then spread across all of our investors through the vehicles that we manage, which is tremendous, again, because I think that any allocation to fixed income is dampening the volatility of the portfolio, but it comes at an opportunity cost in a great equity year. So the more that you can have the, unique ways to add yield to that allocation, incredibly powerful. One of the themes that we've probably talked about so many times, it's one that, worries me so much. We've seen so much money from investors parked in GICs, right? We had some attractive rates a year and a half ago. People went there amidst a very choppy market. But today, we're starting to really see an acceleration of the move out of GICs into fixed income. Can we talk a little bit about the return environment for traditional fixed income portfolios today versus what we're seeing in GICs?
So we were talking a little bit about this yesterday, Alex, right? I guess investors have to ask themselves why they're in GICs. Do you need that safety? They do play a role, but do they need to play such a role within a diversified portfolio? If we're thinking about it just from an opportunity cost perspective, I think you could start from the basis that a 1-year GIC right now yields about 3%. And then if you start to look into the fixed income market, what can you earn relative to that? So the FTSE Canada Corporate Index right now is approximately 4%. And Alex was talking about duration. So you take on a little bit more duration exposure, but again, you get that protection. It's another way of thinking about duration. If we do get sort of this no tariff scenario play out, investors should expect to get around a 4% return. But if we do get this tariff scenario, you'll get that protection on top of the 4%. And then you can start to get into meaningfully higher rates sort of in and around sort of the high single digits, 8-9%.
I want to take us more now to the rapid fire section because we're going to throw a few things at you. If you could describe, Alex, today's bond market in one word, what would it be?
Income.
That's the TDAM way. It's always about the income. What about you, Michael?
I'd say opportunity. Again, I think this is a unique window that we're in right now, and I think the opportunities are quite high.
What's the biggest misconception you still get when you talk to advisors or investors about bonds?
That all fixed income instruments are the same. I know this is supposed to be rapid fire, but I think it's important for investors to realize that in bond land, we have govy bonds, we have investment grade corporate bonds, high yield bonds, leveraged loans, FRNs, MBS, CLOs, inflation-linked bonds. I mean, the list goes on. And each one of them, even before we get to talking about the different credit risk profiles of the issuers, have such different risk characteristics. So not all fixed income instruments are the same.
Michael? I want you to expand on that a little bit because I think we talked a lot about this, in preparing for this chat, is the way that you knit those things together is quite powerful. And maybe talk a little bit about that portfolio construction piece.
Yeah, my initial answer was going to be that bonds are complicated.
Except Alex just made duration easy, so you can't get away with that unless we're going down a convexity
But that's a
curve, no pun
misconception.
intended. Yeah.
I think, I've worked a lot with institutional investors and they think about the role that each asset class plays within a multi-asset class portfolio, right? So fixed income plays that safety role, it plays a protection role. But as Alex mentioned, when you start to expand the opportunity set, you can get meaningful yield enhancement when you start to use that entire fixed income set. So I'd say not complicated, but at the same time can add a meaningful component to a total portfolio solution.
You're just trying to make bonds look as cool as equities. That's what's happening here. Here's one for you. You do this all day, every day. You look at everything. Alex, what's the one economic indicator that you're always keeping an eye on?
It's not just one, but it's anything and everything related to labor markets.
Expand.
So And unfortunately, there's a bit of a lagging nature to official jobs numbers. But whether we look at claims, whether we look at hours worked, earnings, obviously official job numbers that are released on a monthly basis, anything and everything related to people's ability to earn a living wage. Those are extremely important metrics in this environment where there is so much volatility, there's so much uncertainty. At the end of the day, it just comes down to whether people have work and whether they're able to earn wages that help them stay above all of this volatility.
Yeah, because those are the indicators that the central bankers watch, and the central bankers hold the keys to the first decision on rates. I'm going to change the question a little bit for you, Michael. What's the one news headline or the news flow that you're watching really closely when you're thinking about markets?
I think Alex alluded to it earlier. I'm going to say inflation expectations. Every day, businesses and households are making decisions around whether to spend today or wait. And that in and of itself is going to create an impact or transmit to how inflation plays out. Even Alex's comments around labor, when you start to think about wages, when you start to think about expectations and demanding more wages, like that in and of itself creates inflation. So it's those inflation expectations, how people are making decisions around deploying capital or consuming or going out and buying something. I mean, ultimately, at the end of the day, that's what central banks are trying to create, an environment of low, stable, and predictable so that we can make decisions in an orderly fashion and have a healthy economy. But it's those expectations. If those become unanchored, I think that's where we've really got to be focused.
And I think that's where, this concept of the chaos that we're seeing now, in the headlines and so on, it is destabilizing and it causes people to pause, and it sort of has this trickle down all the way through. So any last thoughts as you look forward through the balance of 2025, Michael, as you look at the markets through the rest of the year, what would you say to investors?
I think stay invested. We knew there's going to be volatility. Having a diversified portfolio and staying invested is the key.
Alex, any last thoughts?
Coming into this year, we acknowledged that there would be a lot of political uncertainty.
Noise, yeah.
Yeah, right. And not just noise, right? There's genuine, look in Canada, right? We have an election in Ontario. We're going to have a federal election later this year. Domestically or internationally, there's a lot of political noise and uncertainty. And so we came into this year saying the best way to play this is, to use bond slang terms, is through carry, right? And what that really means is finding income stability using a diverse set of credit levers in our portfolios. And that's exactly how we continue to navigate, the sort of volatility tightrope. So keep calm and carry on.
Mm-hmm. So if I wrapped it up for our listeners, the rate environment is stable to lower, which is net positive for fixed income. The fixed income environment is attractive now from a yield perspective and enhanced with all the tools that we can add to the mix in our toolbox. And it's going to be bumpy, but you're in good hands. So we'll say to our listeners, not to worry, we've got you. So to our listeners, thanks so much for your time. We hope you enjoyed our conversation on the fixed income markets and the rate outlook. Stay well, stay safe.
If you enjoyed this episode, be sure to follow us on your favorite podcast platform and share it with friends and colleagues who love staying informed. A big thank you to our team behind the scenes. Marko Vidovic for producing the podcast, Bianca Sampson for keeping the conversation going online, George Subotic for making sure the podcast reaches you, and Anna Bita for crafting the copy that brings it all together. The views and opinions contained herein are those of the participants and do not necessarily reflect the opinions of and are not specifically endorsed by TD Asset Management Inc. or its affiliates. This is for information purposes only and should not be construed as financial, legal, tax, or investment advice. It is not an offer to buy or sell or an endorsement, recommendation, or sponsorship of any entity or security discussed. Commissions, trailing commissions, management fees, and expenses all may be associated with fund investments. Please read the fund facts and prospectus, which contain detailed investment information before investing. Funds are not guaranteed or insured. Their values change frequently and past performance may not be repeated.